Estate planning is really a very important topic, but it's one that I know people are sometimes reluctant to talk about. So I'm going to try to keep it light today. AARP research finds that 6 out of 10 U.S. adults don't have wills, and many of those who do have documents that are wildly out of date. That's not at all unusual. Since the start of the pandemic, Google reports that searches for how to make a will are 67% higher than they have been at any time since the search engine's history. So planning is something that a lot of folks are thinking about right now, and you might be on this call today because it's something you're thinking about too. So let's cover some things that you can do to support American Humane while at the same time taking care of your family and loved ones and, of course, your pets. On this slide, you'll see there are 5 areas that we're going to focus on. Let's start off with wills and trusts. Wills and Trust 101. This is a wonderful way to leave a legacy of compassion, and it's the foundation of most estate plans. So on the next slide, you'll see it says your will or living trust. First, why do you even have a will? A lot of people ask me this. If you die without a will, your state of residence already has laws in place that say how your property is going to be divided amongst your relatives. The details vary from state to state. However, it's safe to say they may not reflect your wishes, and for sure, they do not include provisions for loved ones you are not related to or for the charities you've cared about. So if you want to be in control of what happens to everything you own, you absolutely must have a will. And I encourage you to consult an estate planning professional to assist you. Now, the term will and living trust, they're often used interchangeably since they both dispose of your property upon your death. A living trust is slightly more complex to set up, and therefore, let's be honest, it might cost more money because it requires retitling all your assets, everything you own, so that everything you own is owned by the trust legally. Then you generally serve as your own trustee during your lifetime. Now, the main advantage of a living trust is that they're not probated and their contents are private. That's a feature that appeals to a lot of people. They don't want everybody knowing their business, and I get that. You're often able to pass property to heirs and beneficiaries a little more quickly through a living trust and with less administrative expenses. Your will, on the other hand, becomes a matter of public record during the probate process because it's filed with the court, and that whole process is administered through your local court. Depending on where you live, probate really can be tedious and an expensive administrating process. But honestly, it's not that way everywhere. So this is, again, another reason that I urge you to consult your professional advisor and see if probate is something that you really should be concerned about, or if in your state and your particular circumstances, it's not something that is really of a major concern. So gifts through your will or living trust are flexible and they cost you nothing now. Those are the 2 main benefits. If you're going to be doing this planning anyway, it's easy to include a charity you care about. There are 3 main ways you can leave a gift to charity through your will. You'll hear these terms a lot. The first one's called a residuary bequest. That's where you provide for your loved ones first, and then you leave a gift to us from what's left. There'll be a clause towards the end of your will that says something like, I give, devise, and bequeath all the rest, residue, and remainder of my estate as follows. And then it might say something like, to the following 3 charities in equal shares. That would be an example of a residuary bequest. There's a specific bequest. That's where you leave a sum of money, like say $1,000, or perhaps a percentage of your estate, 2% of your estate. You could also use a specific bequest to leave a specific item of property, like you might want to leave your favorite niece your antique dining room set, or you might want to leave your home to a charity like American Humane. The last kind of bequest is a contingent bequest. That's one that depends on something else happening. I like to give the example. I leave my daughter $50,000 if she goes to college, if she completes college. If she does not, I leave the $50,000 to her brother. So that gift is contingent upon her completing college. That's a contingent bequest. So next up, the next slide says beneficiary designations. If your will is current and you don't want to make any changes to it, there are still a lot of different ways you could provide for American Humane or other charities you care about through a beneficiary designation. These are associated with certain assets you might own. They will pass directly to American Humane or whatever beneficiary you name without the probate process. They're not controlled by your will or trust at all unless you name your estate as the beneficiary. I will say beneficiary designations have become a very popular way to make charitable bequests in the last 5 or maybe 10 years. I've seen a lot more of them recently in my career than I did earlier. So next, check with your financial institutions to see which of your accounts have the option for a beneficiary designation. Sometimes these designations are called POD or TOD. That's pay on death or transfer on death. Banks and brokerage accounts, investment accounts, they'll often call them that. Certificates of deposit, the same thing. You should check with your institution to see if you have that option on the accounts that you own. Sometimes people will have a life insurance policy or maybe a commercial annuity that is no longer needed by their family. So naming a charitable beneficiary is a great way to use that asset to support a cause that you care about. A word about donor-advised funds. Donor-advised funds are great. They're really more popular than ever now because they allow donors to bundle charitable gifts into one year when they give to their donor-advised fund, and then they can make distributions from the donor-advised fund whenever they want. Now that so many people are no longer able to itemize deductions and take charitable deductions that way, this option of bundling it through your donor-advised fund is more popular than it's ever been. Now, here's a little secret. Many people don't know that you can name a beneficiary to receive the remainder of your donor-advised fund upon your death. Donor-advised fund administrators don't tell you this because they want to keep those assets in their portfolio forever, because that's their job. I get that. But if you're using a donor-advised fund to set up multi-generational family philanthropy, that's terrific. I encourage that. I love to see when families get involved in philanthropy and make these decisions together. It's a wonderful thing. But I just want people to know that there's another option. If that's not how you're using your donor-advised fund, you could consider a beneficiary designation as a way to wind down the donor-advised fund after you die. Lastly, beneficiary designations are available on your retirement plans. In fact, they're required on your retirement plans. You probably currently have a family member named as your beneficiary, and that's appropriate. But let's spend a minute looking at this asset. These are a tax-savvy source of charitable giving from your estate, and you might not be aware of that. So the next slide. Qualified retirement plans and individual retirement accounts. For various retirement plans, your contributions are not included in your taxable income as you make them during your lifetime. When you retire and you start taking withdrawals, that's when the government taxes those. These are called tax-deferred retirement plans. You hear that term a lot. What you may not realize is that the combined state and federal taxes on these accounts may reduce the amount that your heirs receive by as much as 50%. These are a highly, highly tax-burdened asset. Charities like American Humane, however, are not subject to those taxes, so we receive 100% of the remainder distribution in that estate, in that asset. So these assets might make a very tax-efficient way to include charitable giving in your estate plan, allowing you to leave less tax-burdened assets to your heirs. So perhaps life insurance is better for your heirs. If you own a qualified retirement plan or an individual retirement account and you're planning to leave it to your heirs, I very much encourage you to discuss that with your professional advisors, particularly this year. I've highlighted a couple things at the bottom of this slide, some tax changes that happened this year that you might want to touch base with your advisor about. There's a thing called required minimum distributions. You have to take a certain amount from these particular retirement plans every year once you reach a certain age. So the RMD has been raised to 72 by the recent Secure Act and CARE Act. And it's also been waived for 2020. So you're not required to take a distribution this year if you don't want to. Perhaps more importantly, they've made changes to inherited IRAs, sometimes referred to as stretch IRAs. That affects how many years your heirs have to complete the withdrawals of any account that they inherit. They used to be able to stretch that out over their entire life expectancy, so they could just take out a little bit every year. Well, recently the government has decided that they'd like to get their taxes sooner than that, so they've now changed it so that with the exception of spouses, it's 5 years for almost everyone. So that's definitely going to affect some people's planning, and I encourage you to take this time to check with your advisors regarding that. So the next slide, we're going to talk about the last great tax break. I have one more final thought on charitable giving through your retirement account. There's something called the qualified charitable distribution that you can make from your individual retirement account. If you are 70 and a half or older, you can give up to $100,000 per tax year per account holder. So if you're a married couple and you both have an IRA, you can give $200,000 directly from those IRAs to a charity. This counts towards your R&D in the years that it's required. Obviously, it won't this year. But the best thing is it is not counted towards your taxable income. So the QCD is still available this year. It was not affected by any of these new tax law changes. So if you have an IRA and you already make gifts to charity, I urge you to consider this method of giving. Many of us, again, are no longer able to itemize our taxes and claim those charitable deductions. This is a way to give you virtually the same outcomes since the money is distributed directly from your IRA and it doesn't count as taxable income to you. So this is, again, something, check with your IRA administrator. I do have a sample letter that I provide. Many people find this helpful. It's a sample letter of instruction to your IRA administrator. If you'd like to see what that looks like so that you could adapt it and use it to make your charitable gifts in a more tax-efficient way this year, just email me after this webinar and I'll be happy to send you a copy. Now we're going to talk about gifts that pay you income. These are gifts that pay you income for life, and then they leave a charitable gift. So if additional retirement income is something that you think would benefit you, this next section might really be of interest to you. First, let's talk about charitable gift annuities. I've actually just spent the last couple of days working on a charitable gift annuity with a lovely couple from New York. So a charitable gift annuity is a contractual arrangement between you and American Humane. We follow the suggested rate of the American Council on Gift Annuities, as do most charities who offer gift annuities. And it works like this. If you are over 65 and you're making a gift of $10,000 or more to a charitable gift annuity, we'll pay you or up to 2 beneficiaries fixed payments for life. The charitable part of that gift is tax deductible if you itemize, and part of the income payment that you receive is tax-free for a certain period of years. At the end of the contract, the remaining funds further American Humane's work. I have this really neat software that lets me do a customized illustration for you. I can just plug in the amount you might be thinking of and your age, and I can show you exactly how that would work for your situation. Again, call or email me anytime after the webinar. I'm happy to do that. Next up, on the next slide, we have another kind of gift that pays you income for life and then makes a gift to American Humane. These are charitable remainder trusts. This is a type of trust that you would establish with your bank or other financial institution. You choose the payout rate and other terms to meet whatever your desired income and tax benefits are. You could choose it to pay more income and less of a tax benefit, a tax deduction, or if you want to maximize your tax deduction, it could pay less income. So it's very flexible. So you set up this trust, then you transfer property into it to fund it, and at the end of the trust, whatever is left comes to American Humane. I like to say these come in 2 basic flavors. As you see on the slide, there's the CRAT. Yes, everything in plan giving and estate planning has an acronym. I'm sorry about that. It's just one of the things that makes everybody confused about estate planning and charitable giving. But it's not that complicated. A charitable remainder annuity trust pays a fixed dollar amount, like the word annuity implies. It's going to pay you a fixed dollar amount every year, regardless of market conditions. So people choose this option if they really just want to know exactly how much money they're going to get every year. Then there's something called a CRUT, a charitable remainder unit trust. This kind of trust pays you a fixed percentage of the trust's value as it is revalued every year. So therefore, it's going to vary with the market. So you're going to get a little different amount every year. Now, the advantage that you get by going with that option is that you can accept, that trust can accept additional gifts into it once it's established. So if you established it with $100,000, let's say, and 3 or 4 years from now, you want to put another $100,000 in it, you can. You don't have to establish a separate trust. You can just use this one and keep adding to it if that's what works for you. The other thing about a charitable remainder unit trust is that it's an extremely flexible instrument. I could spend an entire webinar talking to you about all the different ways a charitable remainder unit trust could meet your planning needs. But let's just give one example. So you could set up a charitable remainder unit trust, fund it now because you're, say, in your 50s and you're in your highest income earning years, perhaps, and you want the tax deduction, but you don't really want it to generate any income right now. You can put the income off till you hit, say, your 65th birthday or your 70th birthday and just get an income tax deduction now that you can carry forward for up to 5 years, and then let it accumulate and grow until you take the income. So that's just one example. I'm not going to go into any greater detail today, but just know that either of these kind of trusts can be based on your lifetime or yours and a beneficiary's, or it can be set up to run for a period of years up to 20. And I'm happy, again, to use that software and run some illustrations and answer any questions that you might have. Okay, so we have one last section on giving, and then we'll wrap it up with some information I'm providing for our pets. So if you're a fan of the game show Jeopardy like I am, then you can think of this next section as the potpourri category. So let's turn to our next slide. I call this category, Did You Know You Can Give? So, Alex Trebek, I'll take Did You Know You Can Give for $100. On the next slide, you'll see gifts of appreciated assets. Did you know that appreciated assets make great charitable gifts? Real estate and publicly traded securities are the two most common. So let's start with real estate. Your home, a vacation property, an office or maybe a business building that you own, or single-family, multifamily rental units that you might own, all are potentially great sources for a charitable gift. There are different ways you can use real estate in charitable giving. You can do an outright gift of property. For example, you might have a vacation home that you don't use anymore. Or you can do a partial interest in a property that you're planning to sell. Maybe you've got a rental property that you're going to sell, and it's going to have some ugly tax consequences attached to that sale. You could give a partial interest, say 25% interest in that real estate property, to American Humane before the sale, and then effect the sale, and you'll get a tax deduction for the fair market value of the real estate. You'll pay no capital gains tax on that gift portion of the real estate, and it's removed from your taxable estate. One other way, did you know you could give your primary residence to a charity like American Humane right now and keep the right to live there for the rest of your life? This is a really good option for some people. It's called a life estate. It also works not just for your primary residence, but a farm or a vacation home are also allowed under the definition of a life estate. So you can give it now, retain the right to live there for the rest of your life, and then it comes to American Humane upon your death. But when you give it now, you're going to get a tax deduction for the fair market value of the gift portion of that, and you're going to pay no capital gains tax on that, and it gets it out of your taxable estate. You probably realize that you could give real estate through your will, because we've kind of talked about that. That would be a specific bequest, right? If you leave your real estate to American Humane through your will, that's a specific bequest. But did you know about a thing called a transfer on death deed? I've seen these a lot in the last few years. They're becoming very, very popular. They are permitted in over half of the 50 states and the District of Columbia. So check with an advisor to see if it's available where you live. It's very simple. It works just like a beneficiary designation for real estate. You'll record a new deed, and you'll draft a new deed and take it out of the courthouse and record it that names your beneficiary. It's very simple to do. It's really not even very expensive. So it's a great way to get real estate out of your probate estate. Real estate is most people's single largest asset, so it's often what causes their estate to come under probate. So a transfer on death deed can help you avoid that. What are the benefits of real estate gifts? Well, like we said, you get a fair market value on your taxes, a fair market value deduction, and you pay no capital gains tax. There are a number of circumstances under which real estate sales are going to be subject to capital gains tax, and you'll be able to not have to deal with that. It also removes it from your taxable estate. Gifts of appreciated stock. These are really easy to transfer electronically. They're becoming a very, very popular gift as well, because it's just so easy to pick up your phone and tell your broker, I like to make my gift to American Humane this year through a gift of stock, and they transfer it to our brokerage, and that's it. It has to be held for more than 1 year. It must be appreciated stock. If you have stock that you're holding at a loss, you're going to want to sell that and realize the loss and then just make a cash gift. But if you have stock that, say, you bought 2 or 3 years ago for $5,000 and it's now worth $10,000, you can give it to us. It's a $10,000 charitable gift, and it only costs you $5,000. So for some people, that makes them feel like they got a really good deal on a charitable gift. Now, every time I've said taxable estate, I have heard some of you rolling your eyes because you're thinking, come on, Kay, I'm not worth $12 million. I don't have a taxable estate. And it's true that right now the federal estate tax only applies to estates worth more than $11.58 million. So I get it. Right now, you might not have a taxable estate. I don't either. I wish I had that problem, right? But tax laws change all the time. In fact, a couple of slides back, I just gave you a couple of examples of recent tax law changes. So in 2025, we already know that the federal estate tax is set to revert to the 2017 level, which was $5 million indexed for inflation. With our current federal deficit, there are many tax experts that believe the federal estate tax is going to be on the table before 2025. So it's something to keep an eye on. And don't forget, many states have their own estate and inheritance tax laws. And you can bet those generally kick in well before $12 million because they want to get their money too. All right, moving on. Next, cars, boats, and more. Did you know that we have a great vehicle donation program? If you listen to the radio, you probably know what that is. There's a couple of them that have songs out that, frankly, I just can't get out of my mind once I hear them. They're very easy to use. Just call the 800 number that's on this slide right here or go online. We'll tow it away at no cost to you. And we accept more than just old cars. Through the years, I've been a number of places where we've had vehicle donation programs. And I've seen gifts of boats. I've seen RVs. I had a colleague who did a gift of farm machinery with someone that they worked with. Lots of other things are possible. So basically, if you have something taking up space in your driveway or your barn, let us know. Why not turn it into a cash to support our mission? The next slide, and this is the last one in the potpourri category. Did you know you could give artwork, jewelry, or collectibles? These are a great source of support for animals in need. Maybe you're downsizing your home, or you just have some art or antiques that are sitting in storage somewhere that you don't use anymore, you don't have a place for. We're happy to work with you to evaluate their gift potential and ensure that you receive the maximum charitable deduction possible. So give us a call if that's something that you're considering. I will note here, though, that artwork, if you have art that you're considering as a potential charitable gift, please do reach out and talk to somebody before you do that. You would think that's very, very straightforward. It's not as easy as you think it is. There are a number of really complex little things around the gift of art. So in some situations, absolutely, it's a wonderful, wonderful gift. And in other situations, it's going to get really tricky and it just may not work for you. So do reach out if you're looking at art as a potential charitable gift. The very last thing we want to cover is providing for our pets if we're no longer able to do so. This is something a lot of pet owners ask us about. And I don't know if you've been to the plan giving section on our website. There's going to be a link to it at the end of the presentation. We have a number of downloadable resources for you there. And one of them is a brochure on pet trust. That is the most frequently downloaded resource on our website. So that shows me that this is a topic that many, many of you are thinking about. Professional advisors may not include this in your planning unless you prompt them to do so. It could just be that they're not pet lovers, or maybe they just don't know that you are. Either way, it's something that you want to bring up. So, lastly, let's talk about a pet trust provision in your will for their care. The next slide says sample pet guardian language at the top of it. If you need to leave a very large sum of money for the care of your animals, maybe you have many animals or a complex situation, or perhaps you have pets with special needs. I've also seen situations where someone owned an especially long-lived pet, like a parrot or a turtle. I had a donor in Philadelphia many, many years ago that I worked with for a long time, and she had pet turtles. She was in her 90s at the time, and she had some turtles that were only in their 20s. So she definitely had to think about their care, their ongoing care and protection. So if that's your situation, then you may want or need a formal pet trust. A pet trust is a separate legal entity that you set up. You're going to fund it just like you would fund any sort of trust. Put money into it. You're going to appoint a trustee who's going to oversee how those funds are used. And that trustee will also be responsible for dispersing funds to the pet's designated caregiver, who you also name within your pet trust. A pet trust does allow you a lot of control. Many people like that. You can include as much detail as you would like about the care that's to be given to your animals, and you can require regular reporting to the trustee about it, perhaps as a condition for the trustee making the next payment to the animal's caretaker. So it provides a kind of oversight that many people want, and that many people they feel comfortable having that. It makes them feel good about their planning process. So if that's your situation and it makes you feel comfortable, I always encourage people to do it that way. You can establish a pet trust now and fund it, or you can establish it through your will. Doesn't matter either way. Pet trusts often leave the remainder of the trust to a charity after the death of the last pet. That way it's one more gift that you can do. You can leave it in honor or memory of your pet if you'd like. So again, if that arrangement, a formal pet trust, makes you feel comfortable, absolutely do it that way. On the other hand, some people opt for something less formal by establishing a pet guardian in your will or living trust. That's the sample language I've included at the top of this slide just to give you sort of an example of what it would sound like. I'm not going to read it to you. It's pretty straightforward. You could think of it a little like naming a guardian for your minor children. So you're going to name at least two people, just in case the first person you name for some reason is unable or unwilling to do it when the time comes. Or perhaps you're going to name 2 people because your cats are going to go to one person and your dogs might go to someplace else. Someone else. There could be reasons for that. So name at least 2 people. I also urge people to consider providing a sum of money for pet care. We all know that having pets is expensive beyond just feeding them, giving them treats, in my case, buying little sweaters for my dogs, all that sort of thing. They also have veterinary care. And as they get older, much like us, their medical care can be more complex and more expensive. So if you want to ensure that your pets are cared for just like you would care for them, you want to be able to provide for that expense so that you know the money is there. Last but not least, talk to your chosen pet guardians before you name them in your documents. As a lawyer, I would actually see this when people were naming guardians for their children. I would have to urge them to talk to the person about it. Oh, I'm going to name my sister as the guardian of my children. That's great. Did you talk to her? Well, not yet. It'll be fine. She won't mind. Let me just tell you from experience, no one wants to find out that they're the caregivers of your herd of llamas when they get a phone call from the executor of your estate. So get their consent, discuss all your expectations and your hopes regarding the care and comfort of your pets, and also any special needs they have. I know that a lot of us have special needs pets because they're rescued. One of mine is a very traumatized little rescue dog, and he's extremely nervous, and he just requires a little different care than some dogs would. So that's definitely something that I have to think about with regard to my own pets. So that's it on pets and pet trusts. So that concludes my presentation. If you turn to the very last slide, you will see a picture of me and my little dog, Oliver. You have my contact information right there. You have my email, my phone number, and a link to the Plan Giving website where you can download a bunch of additional resources. Thanks for joining us today. I really hope you found this informative and helpful. I let people email me in advance if they had a question. So I did get one question via email, and that's a good one. It was, how can I sign all these documents and forms while we are social distancing and many businesses are closed? I can't find a notary. Well, that's a good question. It turns out that remote signings and virtual signings, even with notaries, are becoming, quote unquote, a thing these days out of necessity. So you can do some online research and you could probably find a service in your area. You should check with your state or locality to see if this is a legally valid option for the particular document that you need to execute. We've been doing these kind of remote virtual signings for real estate for years, so the technology isn't new. It's just new to this particular use. It's occurring to us now that this would be really helpful. You could also check with your bank to see if they have a notary and if you could make an appointment to go in person and have everybody still maintain social distancing while you present your ID and everybody takes turns signing the document. So thanks for that. I think that's a really relevant question right now.